Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Eric, pretty strong statement.
I think we're putting it all out there this time.
That annuities eliminate retirement failure.
Yes. Mm-hmm. Well, and I think it's how do you define retirement failure? In my case, it's pretty simple. You run out of money.
Yes.
If you run out of money in retirement, you're done. So,
and I think this is a fear.
Yeah.
I mean, this is a genuine fear
Yes.
and a reality that most folks have seen happen with someone in
Right.
their lifetime.
Yeah.
And the question is, why should any of us take that risk of running out of money?
right. And we've seen family members, and it could be a long-term care or health care situation, something that happens, the unexpected. You can't plan for some of those things. You can anticipate them. You do your best to adjust for them. But it's the things that you can plan for and in retirement and how to avoid it and how an annuity can really help eliminate some of these potential pitfalls, especially early in retirement.
Yes.
I'm a big fan of sequence of return risk. And not a big fan. I'm actually not a fan of it at all. But for retirees, that is one of the biggest potential impediments to a retirement or the retirement is the chance that right after they retire, the market takes a nice little dip, a little bear market, and that sequence of return risk is just paralyzing. People that projected to have money for 30, 40 years, all of a sudden, because of 2 or 3 bad years early in retirement, they run out in 10, 12 years.
Well, and I think, folks, unless you've run the numbers, you've sat down and looked and modeled it and looked at it, many times it comes as a shock. In the back of our minds, we think, well, if the market dropped dramatically, I could be in trouble.
Yeah.
But when you actually look at it, Eric and I have looked at many models, of it's kind of like the reverse, sequence of returns that you're having when you're withdrawing your money. But I have one right here that we're looking at that kind of goes back to 1975. And, if you were pulling your money out up to the financial crisis in 2008, not even having to go through the financial crisis, if you started in 1975 and you took a withdrawal rate of about 5%, which is pretty much what we do with annuities.
Which was expected kind of for that time period,
yes,
too.
Yes. That you would end up with $3 million still in your account to go on to your heirs.
Yeah.
But if we flip this chart around, and we look at starting our income in 1973.
2 years earlier.
Yeah, just starting at 2 years earlier.
Same withdrawal rate.
We're completely out of money by 1991. And we're broke.
And it's because of the sequence of return.
Right.
And you've got 2 really bad years to start retirement.
And yet we had average returns of 7% during this time, and we were only taking out 5%. But folks don't understand that.
How the market impacts.
In this article that we're going to talk about here a little bit with Wade Fowle, he talks about the larger your portfolio,
the bigger the risk.
Right, because every time there's an adjustment in the market, it affects a lot more of your money percentage-wise.
Right, and when you're pulling dollars out of an asset, as we say, reverse dollar cost averaging, so to speak, you've got a larger asset. If the market takes a dip, those of you that had more money get a larger withdrawal percent. If you lose 25% of $10, it's not nearly as bad as losing 25%
of $1
million. So there's more risk for those people who potentially have a larger, basically, spending need in order to maintain that level of comfort.
We talk a lot about annuities being able to eliminate this type of risk. Now, it obviously, annuities aren't a silver bullet. There's nothing magic about annuities. First of all, you have to have enough money to retire, and to put into annuities. Just buying one, $5 isn't going to get you a good income.
If you haven't saved enough, an annuity is not the panacea.
No. And if you have a reasonable portfolio to retire on, annuities are going to give you a foundation for that portfolio. And it's not just any annuity. It's the selection of the right annuities to put into that portfolio. So let's talk about some of the options that are available.
Well, of course, there's the good old standby, the SPIA,
the immediate annuity,
premium immediate annuity, which basically you give them the asset, and they're going to give you an income for life.
So you give them a cash lump sum, and more or less say goodbye. I mean, you can take a little less income to pass some of it on to your to your kids in the form of payments or a refund of what you haven't used if you pass early. But most people tend to like the idea when they're using an immediate annuity. Many times they're not worried about the heirs.
No, it's a longevity insurance policy basically. It's
Yes.
it's gonna pay you as long as you're here. So you're betting on a good long life. The insurance company is basically using its actuarial calculations to figure half are you going late, half are you going early, and in between we're gonna basically balance the pool of risk over those two classes.
And this is for an income-oriented portfolio where the foundation of the portfolio is income. And there's a couple of other annuities that use what we call living benefits. One is the variable annuity, and the other is the new hybrid style indexed annuity, fixed indexed annuity.
Yeah, and of course there you've got a withdrawal capability, a lifetime withdrawal capacity, so to speak, that will continue as long as you're alive. But the difference is you still get to maintain control of the asset, or at least majority control. There are surrender periods involved in the earlier years, but you still have that lifetime benefit ability, and you still have the ability to get some growth, either through market participation or index participation, depending on the annuity.
So to kind of clarify this, because I know folks get confused on this, the immediate annuity annuitizes, the big word, annuitizes your money so that it's not available. But an income rider on a variable annuity or a fixed indexed annuity gives you that same lifetime guarantee, but it does not annuitize. So your money remains in your account and can still get some growth, and it only leaves the account as you're spending it, but your income is guaranteed as long as you live. So should you live long enough and you wipe the account out, the income continues.
Yeah, the annuity company is still using those same actuarial calculations. Now, the difference of the SPIA or the immediate annuities are typically a little bit larger payout percentage. Potentially. Sometimes. In today's environment, it's not as big a difference as it has been in the past.
Especially when you're deferring it a little bit of time. Because they've now come out, with legislation for the new 401k rules. Where you can buy the longevity annuity that has some growth, some rate of return until you turn it on. But if you compare that to the hybrid style or even the VA that has the upside, roll up, that type of thing, it tends to not perform as well. Eric, one of the other concerns that folks have that don't have an income need is growth. They want a portion of their portfolio that they know is going to get some type of a reasonable rate of return.
They want the safeguards in place so that basically they don't move backwards. They don't care about having astronomical growth as long as they get safe, consistent growth in their portfolio.
And income may be a secondary need that, depending on, the one spouse predeceasing the other, or having problems with the pension or the Social Security or something of that nature where they could fall back on it. What they really want to know is that some portion of their portfolio, whether it's, a third of it or 25% or half, is completely protected from market risk in their later years.
And that's where the strength of kind of this indexed annuity comes into play. You don't have to have an income rider on an indexed annuity. There's a fixed indexed annuity that has typically better growth potential than just a standard MIGA style annuity, and there's your other option as well. What better than which is a multi-year guarantee annuity, which is kind of a CD style annuity. You're getting the same guaranteed rate over a period of time. But then you've got your indexed options that can get a portion of that market upside and really do keep you from going backward.
And I think that this is one of the differentiating factors between the variable annuity and the hybrid indexed annuity, is that most folks choose the hybrid indexed annuity because they want that foundational principal protection, and they don't get that typically from the variable annuity.
The people that want the VA are typically want the market participation. You want the ride, the highs. You're convinced that the bear is not coming.
And they're accepting of that volatility.
And if they know what they did is they bought insurance on their money, if the bear shows up, they understand that they had a ratchet or a guarantee applied there that will protect their income for the future, because that's really what those riders are doing.
Exactly, and since we're really saying that in a lot of cases that folks really are just looking for principal protection with a reasonable rate of growth, that's why the hybrid annuity, the hybrid fixed indexed annuity, has become so popular in recent years.
And to let me kind of pull us back a little bit to why we would say, in this case, all right, annuities eliminate retirement failure. We know we're at risk when we retire. It's usually the biggest risk is in those first 5-10 years.
5 to 10 years.
And if you get negative returns in that time period, you're likely to have the biggest downside later on. You're more chance of running out of money.
So you can truly run out of money.
So by putting an annuity as a portion of that, what does it do? Well, this is what we call zero is your hero. Rather than having to suffer some of those down 20, 30%,
those big losses,
you get a zero.
Yes.
So your principal you're taking withdrawals, but your principal is never suffering those big drawbacks. And so those sequence of returns are not nearly as impactful. Now, yes, you're giving up some of the upside on the other side,
yes.
Especially with the index side here. Obviously, I guess I should clarify. I'm talking about index annuities and not variable annuities because your principal would be at risk in that case.
Right.
But that's where it can really help, level out those big swings. And as you're retired, you don't want those big drops.
Right.
They can be paralyzing because you have to then have the time to recover to get back to where you're comfortable.
I was going to say, when you're determining, how much you want to put into an annuity, we look at it as backing into it. What is the foundation that you really need for your income?
Yes.
And so what you really want to do is figure out what's the least amount of money that I could put into annuities or an annuity to satisfy that need. And that'll be the foundation of my portfolio. So looking at your Social Security, potential pensions, and that annuity, that becomes the foundation, which then frees you up to, first of all, to sleep a little better at night, and then to be a little bit more aggressive with your investments.
Right. Take care of the foundation with whatever guaranteed sources you can, and then have that flexibility as well. And we've talked about using, guaranteed pieces like bonds, in this case, replacing bonds with annuities to take some of that interest rate risk off the table that we all feel is kind of potentially down the road.
Right. And longevity risk.
And you've taken longevity risk off the table.
Yes.
So what better thing to do than eliminate retirement failure than to consider an annuity for the foundational portion of your portfolio?
It does work.